State of the market video 2. This is big. We're going into earnings season. So on Friday, we had some earnings from the banks. I would say Chase earnings were slightly good. Bank of America earnings were slightly good. Wells Fargo missed. Citigroup missed badly. BlackRock beat, but year over year they had less sales and less earnings. The only company that had a good report on Friday was United Healthcare. And if you've been following along, reading my posts, watching my videos, energy and health did great in the year 2022. Right now, the way energy is going with oil down and natural gas keep going down. I don't know how natural gas at 350, 360, because in a normal winter for the last 5 years, natural gas is closer to 4 to 450, not 360. Now we got a war in Europe. We got natural gas in Europe around $15, $20. So we're gonna export it. Companies are gonna figure out how to export it, but this is not about that. But the good thing about that is it's not a good thing, but that tells you energy helped the S&P 500 in the year 2022. They dropped earnings. Oil companies, electric companies, natural gas companies, companies that produce, that store oil, that ship it, they all did tremendous. So if energy is down in 2023, who is going to hold up the S&P? Who is going to hold up the S&P? Right now, well, January 1st, energy was about 7% weighting on the S&P 500. Tech was close to 40% in the January 1st of 2022, but they all got whacked, and it was instead of 40%, it got closer to 25%. Healthcare went up because these are market weighted, and healthcare is still doing well. So companies like United Healthcare, Merck, Eli Lilly, Johnson and Johnson, Humana, Centene, like healthcare companies did well, and they're still doing well. Energy is a little bit coming off. 2 weeks from now, I'm going to try to go over some of the sectors that are still doing well to try to help you guys if you guys don't already see it. But right now, this is earnings season. So this week, we're going to have some earnings, but not even a lot of earnings. Next week is going to be a flood of earnings, and you are all going to see, and I apologize, but I'm not the companies. These companies are going to let the cat out of the bag because they have to give you all earnings results. They have to give you, they're scheduled to do earnings results. What are they going to do? Not give earnings? You can't not stop earnings. And I keep saying that because the market is going up. The S&P is near 4,000. Right now, S&P is near 4,000. S&P earnings are supposed to be near 220, low 220. So we're like at 18, 19 times earnings. And in a normal situation, and we're not normal, but I'm saying in a normal situation, we're between 17 and 18. And now we're getting close to 19. We're not there yet, but we're getting close to 19. And in a normal situation, S&P 500 company earns 5 to 10% more year over year when you compare. Their sales are 10 to 20%. It doesn't go for every company, but the S&P 500 has 500 companies. So if you take them all, the average S&P 500 grows earnings at 5 to 10, sales at 10 to 20. And I keep repeating that because watch the earnings coming. You're not going to see 10 to 20% growth on sales. You're not going to see 5 to 10% growth in earnings. What does that mean? That means why would the S&P that normally trades at 17, 18 times, grows 10 to 20, earnings 5 to 10, and they're going to be decreasing. Why would you give the S&P 17 to 18? What does that mean? That means you've got to give it like 15 or 16. So if I give the S&P 16, right? I'm giving it 16, and my earnings are about 220 for this year. Next year, I'm going to make a decision on next year once I see the reports coming in right now. So, but right now I have it like 215 to 220. So if you give this 16 times earning, that's where you come out with 3,400. There's no 34 to 3,500. There is no reason that the S&P 500 should be over 34, 3,500. I just gave you a systematic formula why that I came up with. This is me. This is why I don't see how the S&P is over 34, 3,500. And if you go by my logic, chances are it's going to go lower. How low? I'll know when I see the earnings, because all I can tell you is earnings is going to be bad. You saw it on Friday. Chase, Bank of America beat slightly. They beat slightly. So what? So give them a 70. But these are huge companies, even on the Dow Jones. So let's give them a 70. Citibank, Wells Fargo missed. All right. So let's give them a 60. Well, actually, Citibank missed both bottom and top. And I think they missed one of them by like 3%. So that's not even a 60. Let's give it a 55. All right. So that was Citibank. Wells Fargo, let's give it a 60. The only one that was good was United Healthcare. So if the average company is giving you a 60 and not growing like it should, there is no sense in giving 18 or 19 times. And on top of that, we keep hearing things about the Fed pivoting. The Fed is going to make a decision on February 1st. I still believe they should go with 0.5 rate hike on the February 1st meeting. March 15th, they should do a 0.25 and wait. 0.25 and wait. Now, they could do a 0.25 3 times or 2 times, but they should do a 0.5 because 6.5 inflation is not good. It's not good. On top of that, we have unemployment actually went down to 3.5, and GDP, gross domestic product, is supposed to come in at around 3%. I think that's towards the end of the month. I have to find out. I don't know exactly when it comes out, that number. But if the economy is still growing, unemployment is low, inflation is high, the Fed has ammo to raise interest rates. 4.4 interest rate is still low if you go back over all the years. Normally 3 to 5%. So anything below 5% is still normal. I still feel like the Fed is going to 5.1 or 5.2. So that's a hike of a 0.5 and a hike of a 0.25 and a 0.5 or 3.25s. I feel the Fed should still go a 0.5 because inflation is cooling, obviously, but it's still high. 6.5 is high. The Fed wants to see at the end of this year a 3 handle and next year in the 2s. But by the end of this year, they want to see a 3 handle. You can get a 3 handle if we raise rates high and quickly. If you don't raise rates high and quickly, the chances of getting down to a 3 are not easy. Right now, the numbers are dropping quickly. But once we get to 4, 5, it's not going to drop by 0.5 every month. It's going to drop by 0.1, 0.2, 0.3. It's not going to drop 0.5 or 0.6 like it's dropping now. It's going to slow down the drop. So earnings are coming down. Inflation is high. Rates are going up. What does that mean for the market? Bad news. Bad news. We're not horrible news right now. At least I don't think earnings are going to be horrible, but earnings are going to be bad. Horrible earnings is everyone comes in, miss top line, miss bottom line by 5%, and year over year, growth, not growth, a decrease in sales 10%, a decrease in earnings 10%. That's terrible. If we see the S&P 500, instead of earning $220, earn $200, there is no reason the S&P should be over 3,200. I'm telling you right now. But I'm not saying earnings are going to be 200. I want to see what happens right here in the fourth quarter, how much we earn altogether, because I have an estimate between 215 and 220. The consensus on the street has been lowered to, I think, 226, and it started off at 250. So that's to give you an idea. That's the state of the market.